Hey there, and welcome to this explainer. If you've ever stared at a day trading chart and felt like you were trying to decode some sort of alien language, trust me, you are absolutely not alone. All those flashing red and green bars, the moving lines, the overlapping zones, it can just seem like total absolute chaos. But today, we're stripping all that noise away. We're going to zero in on the pure mechanical heartbeat of the MNQ pullback strategy. Our goal here is incredibly simple. We're going to take this seemingly complex system and break it down into basic, bite-sized Lego blocks so that literally anyone can understand exactly how it works and, more importantly, why it actually works.
Okay, let's dive into this. Here is our roadmap for the day. We'll kick things off with Section 1, Decoding Trading Jargon. Then we'll hit Section 2, the 4-step formula, and apply it in Section 3, Buying with the Bullish setup, followed by Section 4, Selling with the Bearish setup. And finally, we'll wrap up with Section 5, Essential Rules and Risk. Let's get right to it.
All right, Section 1, Decoding Trading Jargon.
First up, we've got the EMA Cloud. Think of the EMA Cloud as our big picture trend indicator. On the charts, you're going to see this as a very distinct blue shaded area. It essentially acts like a visual river, or kind of a guide rail, for the price. If that cloud is sloping up, well, the river is flowing up. And that tells us the overall market direction is positive. It filters out all that momentary, distracting noise and just gives us the clear macro perspective.
Next, we have the VWAP, which stands for Volume Weighted Average Price. Now, I want you to picture the VWAP as the equator of our trading chart. It represents the mean, or basically the fair value of the asset at any given moment, factoring in both the price and the trading volume. And because it's this fair value equator, price naturally tends to interact with it quite a bit. It acts as dynamic support that holds the price up, or dynamic resistance that pushes the price down.
Our third key term is the engulfing candle. And guys, this is our trigger. It's a very specific two-candle pattern where the second, much larger candle completely swallows or engulfs the body of the first, smaller candle. When we see this happen on the chart, it's a massive clue. It represents the sudden, powerful shift in market momentum, where buyers have just completely overwhelmed the sellers or vice versa. This right here, this is our confirmation signal.
And this brilliantly illustrates the macro environment those indicators help us spot, the uptrend versus the downtrend. In an uptrend, the price is just marching upward, like a staircase, right? Making higher highs and higher lows, all while staying comfortably above our blue EMA cloud and that VWAP equator. Opposing that, of course, is the downtrend. That's where price is descending down the stairs, making lower highs and lower lows, staying trapped below the EMA cloud and VWAP. It's a really stark visual binary that makes reading these opposing market forces incredibly straightforward.
And just like those trends, our engulfing candle triggers come in two distinct flavors, and they are perfect mirror images of one another. A bullish engulfing pattern happens when a small red down candle gets completely eaten by a massive green up candle. That right there is a buy signal. Conversely, a bearish engulfing pattern is when a small green candle gets swallowed whole by a large red candle. That is our cue that the sellers have officially taken control.
Moving right along to Section 2, the 4-step formula.
Listen closely, because every single trade taken with this strategy follows this exact, unyielding heartbeat. Step 1, trend. Step 2, pullback. Step 3, confirmation. Step 4, entry. Trend, pullback, confirmation, entry. If you can memorize that specific rhythm, you'll be able to block out all the emotional chaos of the market and focus purely on your execution.
Which brings us to this core mantra derived from our source material. Trade with the trend. Enter on a pullback. Confirm with price action. This isn't just some catchy phrase to throw around. It is literally the unbreakable law that dictates every single move we make. We never fight the market direction. We never buy at the absolute top. And we certainly never enter without hard proof that the momentum is actually on our side.
Now, what's really interesting about this slide is how it all comes together. Section 3, Buying the Bullish setup. Okay, let's actually trace our 4 steps perfectly on this chart. Step 1, we identify the trend. You can see the market is in a clear uptrend, with the price riding high above that blue EMA cloud and the VWAP line. Step 2, the pullback. The price takes a little breather and dips back down into that blue EMA cloud, or right near the VWAP. This is the market practically giving us a discount. Step 3, confirmation. Right inside that cloud, boom, a bullish engulfing candle forms. The green completely swallows the red. And finally, step 4, entry. We trigger our trade exactly when the price breaks above the high of that engulfing candle. It's just a highly structured, elegant sequence.
Now, to make absolutely sure we don't let our emotions drive the bus, we use a very strict bullish checklist. The price must be making higher highs and higher lows. It's got to be above an upward-sloping EMA cloud and above the VWAP. The pullback has to hold above those support levels, and of course, a bullish engulfing candle must form. But I want to highlight one absolutely crucial hidden detail from the source material here, the volume. For a high-probability bullish setup, we want to see that the trading volume is noticeably higher on the green, upward candles compared to the red ones. That's the footprint that proves buyers have real conviction.
All right, let's look at the other side of the coin. Section 4, Selling, the bearish setup.
Let's move to this chart and see how this builds, because honestly, your learning curve is halved right now, since this is the exact mirror image of what we just looked at. As you can see, the market is now in a downtrend. The price is looking heavy, sitting below a downward-sloping blue EMA cloud and below the VWAP equator. Our pullback in this scenario is actually a temporary move up into the cloud, which is now acting as a ceiling or resistance. We wait for our confirmation, that bearish engulfing candle where the red swallows the green, and then we trigger our short entry, right as the price breaks below that engulfing low.
And just like the bullish setup, we have our strict bearish checklist. Literally everything is inverted. Lower highs, lower lows. Prices below the EMA cloud and the VWAP. That EMA cloud absolutely must be sloping downward. The pullback has to get rejected by that cloud or VWAP resistance, and it's confirmed by a bearish engulfing candle. And once again, do not ignore the volume. For a valid sell setup, we really want to see the trading volume spiking higher on the down red candles.
So the crucial point is coming up right here in Section 5, Essential Rules and Risk.
Listen, having a brilliant strategy to identify entries is honestly completely worthless if you don't know how to manage your money. These are the non-negotiable rules of the MNQ pullback strategy. First, wait for the pullback. Do not chase a runaway market just because you have FOMO. Second, always, and I mean always, use a stop loss. Third, define your risk before you ever click enter, aiming for at least a 2-to-1 reward to risk ratio. And finally, you have to watch out for those common emotional pitfalls. Absolutely no revenge trading after you take a loss, and no averaging down on a losing position, just hoping it's going to miraculously bounce back.
If you take only one single mathematical concept away from this entire explainer, please make it this: 1 to 2%. That is the golden rule of risk management. You should only ever risk 1 to 2% of your total account value on any single trade, period. Keeping your risk small leads to massive opportunities over the long run, and it completely ensures that one bad trade is never going to wipe out all of your hard work.
I really want to anchor your expectations with this powerful quote right from our source material. The goal is not to be right all the time. The goal is to follow the process and protect your capital. You really don't need a 100% win rate to be successful here. High-probability trading doesn't require perfection. It requires immense patience and the robotic, incredibly consistent execution of the exact rules we just laid out.
So, we've taken the alien language of trading charts and translated it into 4 distinct logical steps. We've got our vocabulary down, we know our setups, and we've locked in our risk management rules. The blueprint is literally right in front of you. The only question left is this: are you ready to stop guessing at the market's random movements, leave all that emotional chaos behind, and start strictly following the process?